Hey everyone, welcome back to another episode today. And I'm actually going to go over basically another area that I think it was interesting to me, which is more data driven. And this is going to be about the company Moody's or ticker MCO. So what is Moody's? And Moody's is very similar to another company that I've already gone over, which is S&P Global. A lot of things I said for S&P Global still apply for Moody's, basically beat for beat. And what you're going to see in this in this analysis is going to be something very similar to what I did for S&P Global. So let's get into the core business. For Moody's, right, the core business is investor services and analytics. So both of these are very much similar to S&P Global's bond rating system and then their market intelligence. So that's in regard basically what Moody's has compared to S&P Global. S&P Global still also has that indices portion, which also provides them some income, which Moody's does not have. So let's actually talk about their investor services. This is about a third of the revenue, right? 38%. We can do math, right? It's about a third of the revenue. This is S&P, is the same as S&P Global's rating system, where they're rating corporate bonds, rating the debt issuers, right? So that would be corporations, governments, financial instruments, all of these. And this is something where they get to sell their research, they get to slap on a fee for getting people to rate their bonds having people rate their bonds, and this means that they benefit from times when there are a lot of bond originations. This area also has a very large moat. Like I said, this is going to apply to basically every company within this type of sphere, whether it be Moody's, SP Global, Fitch, or even MSCI to some extent, and even Bloomberg. They have a really large moat, which is based off the background of their reputation, especially for this investor services of the credit debt issuers relationships. This is large moat due to reputation and mandated use of ratings, whether it's within the company or simply because of institutions, governments requiring banks and financial companies to maintain risk levels. So the analytics portion is really the other side that they have. And once again, this is really similar to S&P Global's market analytics. And I know essentially, I am actually basically just reusing these slides because of how similar I do see Moody's and S&P Global are as companies. I think owning one and not the other doesn't really make as much sense because they are this industry. I do think if you really want to get to the nitty gritty, you could probably do some market arbitrage and say, hey, if Moody's is going up and S&P Global isn't really moving, you probably can short Moody's by S&P Global because I do think that they are in very similar fields with the caveat of S&P Global's indices portion. So let's get into the analytics, right? They're selling research and analytics. They're helping in multiple areas with taking a look at company performance, company opportunities, and company management, risk management. So this is actually a really helpful portion, and this is also this portion makes the most amount of money, right? This is about two-thirds of their revenue, and this is also the most stable part of their revenue, being being subscription-based. This does actually put Moody's in a different camp than S&P Global, where S&P Global did have a smaller portion of their money coming from these analytics portion or their market intelligence, meaning that their subscription-based revenue is less steady than what Moody's has. In other words, Moody's technically theoretically should have a better and more sustainable and less volatile type of earnings, at least compared to S&P Global. So let's take a look at the tailwinds. Once again, these four, if you've seen a couple things I've done before, increasingly data hungry will. AI and ML applications. They're expanding into private markets, and the monetary policy is definitely something that is going to be a tailwind for Moody's. Once again, if you look at this is very similar, if not identical to S&P Global side. S&P Global slide, right? Growing demand for information. They have a great reputation of having good data, and they are taken as a source of truth. And this is a really good place for any company to be in. So a lot of this is going to be repetition from what I said about S&P Global. Uh, and really, as more companies want more data, where are they going to be looking for it? They're going to be looking for people that have reputation for good data, which means they're looking at S&P Global, they're looking at Moody's, they're looking at these big institutions that have institutional knowledge about how to gather this data and not really that run-the-mill, just random person off the street. Hey, let's hire this random person, have them build an entire analytic department for us. They're going to be Companies are going to be looking for that big institutional knowledge, and those companies that are able to actually provide that, and that would be a company like Moody's. AI and machine learning applications, right? This is also going to be something that carries over straight from S&P Global. They are going to be able to enhance their product offerings. They're increasing their moats. I mean, at this point, right, the moat for S&P Global, for Moody's, are near impenetrable. It is very hard for any company to start up and actually make that reputation for themselves. But AI and ML is going to be able to improve that moat for them and actually take them further ahead of their competitors, whether it's in prediction, whether it's in analytics. It just provides them even more of an opportunity. It also improves their efficiency, right? You can downsize, you can really use AI to program things faster. So what I, for example, right now at work, right, a lot of something that's really useful would be AI to be like, hey, I do want to code something up really quick. I know exactly how the process works. I can give you step by step, but I don't really want to plug everything. AI is really useful to really increase that user efficiency, especially when institutional knowledge is there and talking and knows how to utilize the data they already have. Private expansion, once again, similar to S&P Global. They there has been massive growth in the private credit and private equity markets. These markets are opaque, and institutions are looking for more and more data to be able to supplement what they're able to get from the companies themselves. So this would be things like economic conditions where consumers are looking to go. And that being said, Moody's being in that position of really just selling their analytics and selling that information and interpretations of that information and projections based off of that data, it is positioned really well to generate that type of information for their consumers to utilize. And this is really going to be something I think is going to propel them forward, maybe a bit more than people realize. Monetary expansion. So with monetary expansion, this is the one thing where I think it differs a tiny bit from S&P Global. They are going to really be easy. They're going to be able to label more loans. They are really going to be able to earn more money from labeling more, uh, basically restructuring loans. This is really the only place that Moody's is going to make the money off of. Versus S&P Global does have a portion of their income that is impacted because of asset prices going up. Moody's doesn't really have that portion as a thing for them. Easing policy is going to be helpful for them, but it really isn't going to be something that is that impactful for Moody's as a whole. So headwinds. This is going to be something that I is also really similar to S&P Global. So when it comes to economic headwinds, regulation, and competition, this is all really similar to what I said about S&P Global. So if you want a deeper dive, you can go into S&P Global. The video I made for S&P Global, and skip to the headwinds and take a look at what headwinds I'm seeing for S&P Global, and they all basically all apply to Moody as well. It's almost one to one. Economic headwinds almost one to one. With revenue connected with the health of the economy, with the reduction in loans, really means that there's less loans for them to label, meaning that they actually get less revenue. Geopolitics, right? Risk off, like I said in that S&P Global episode, which is a reduction in loans. Overall impact, not really that impactful. So I'm going to continue on to the next slide, which is going to be competition. Obviously, competition is slightly different, where instead of Moody's as a competitor, they're not competitive with themselves, they're competitive with S&P Global and Fitch for ratings and Bloomberg for analytics. There's a couple more companies in here as well, but really these are the big companies that are competing for consumers here. And once again, this is something that I stated in the S&P Global episode, and that is in this industry, there is no customer that is only a customer of one. Customers in this space, in this area, are always going to be customers of at least two, maybe even three of these companies because of the type of consumer they are. The type of consumer they are is someone who is looking for that data. They know that data can be wrong sometimes, and so they're not looking to get just one perspective. They're looking for more research. And to get more research, you're going to be complementing the research of one company from the research of someone else. So in this case, even though it is technically competition, the competitors technically complement each other, and they're less of substitutes and more of complements. They're less like Coke and Pepsi and more like root beer and ice cream. So that's how I really view this, which is why I do give a low impact in this competition. And even if there's another company that somehow rises up and becomes gigantic in this industry, that's still not really impactful to S&P Global, to Moody's, because of the type of industry they're in. It would just be essentially another scoop of ice cream into into the root beer float. It would be like that drizzle of chocolate, even though actually I don't know if that sounds good, but you guys get the idea. Regulation. This is definitely something that probably isn't that impactful still, once again, because regulators aren't looking as much to the rating agencies. They're really looking at to make sure that the financial institutions are using the rating agencies properly and that they are taking proper amounts of risk and not overdoing their risk tolerance, which means that regulation, as much as it is impactful, it's not really, because it's not directed towards this industry, is not that impactful of a headwind. So let's actually get to the overall thesis. My overall thesis is that there's no real concern when it comes to headwinds for movies. They have strong and ingrained moats, just like S&P Global. They're in an industry where competition is not dilutionary. It really is competition is complementary, which is an amazing place to be in. It's like if you're, it's an amazing place to be in where even if you're competitive as well, you can also do well, and that's definitely somewhere where you can see a lot of revenue growth. I do see acceleration of revenue in the short term to lower rates and people actually taking out loans. And then long term, because of everything I've said, it is sustainable long term growth. As the economy grows, as companies get bigger and give out loans, as financial institutions look to make money and look at economic conditions and forecasting as they need to do stress tests, all this comes back to that recurring revenue that they get from Moody's Analytics. And this is really the portion which I think technically Moody's is in a stronger position than S&P Global when and if there is an economic downturn, simply because a lot more of the revenue comes from that reoccurring revenue base. Sorry, large more proportion of their revenue comes from that recurring base rather than compared to S&P Global's rating side. So overall price, I do think that this is a hold. I don't really see them having much upside within the next year. I do see them gaining to about $483 within next year. So this is going to be a company where I don't see much upside, but if you have it, I don't think I don't think it's worth it to sell because of tax implications. So once again, thank you guys for watching, and I hope you guys do have a great rest of your day, and leave a like and subscribe if you enjoyed, and tell me what I got wrong about the company and if there's anything else you guys would like to see me analyze. Thank you. Have a great day.